Broadcom is literally building the physical roads of the AI revolution, but are they quietly trying to become a bank too? Welcome to the EDGAR Brief. Today we're cracking open the latest SEC filings from Broadcom, specifically their May 2026 10Q and a very revealing 8K, and we're translating all of it into plain English. Quick note before we jump in. We are independent, not affiliated with the SEC, and we are absolutely not financial advisors. We use AI to help summarize these massive documents so errors can happen. Always verify on sec.gov before making any money decisions. All right, let's get into this explainer.
I want to kick things off with a number that genuinely made me double take. 42%. That is a staggering figure. Broadcom is this massive, highly diversified technology giant, and yet 42% of their entire revenue stream in the most recent quarter came walking through the door from just one single distributor. Honestly, that's the kind of concentration that keeps executives staring at the ceiling at 3 a.m. It's a thread we're going to pull on throughout this whole explainer. But first, let's figure out how this company actually brings in its cash.
Section 1. The Broadcom Business Model.
So, Broadcom basically has a split personality under one roof. For the quarter ended May 3, 2026, 68% of their net revenue came from semiconductor solutions. That's the physical hardware. The other 32% came from their infrastructure software division.
Think of Broadcom like a master contractor during the AI gold rush. On the hardware side, they aren't necessarily building the AI software models themselves. No, they're building the specialized, high-speed roads, the custom AI chips and networking hardware that let data travel at light speed inside those massive AI data centers. Meanwhile, on the software side, with products like VMware, they operate a lot like a corporate landlord. They're basically collecting monthly rent on software toll booths that help huge enterprises manage their complex IT systems. So they pave the physical roads and they lease out the digital toll booths.
Moving right along to Section 2, the Q2 scorecard.
So are more dollars walking in the door compared to last year? The answer is a resounding, absolute yes. Just look at this jump. In Q2 of 2025, they brought in $15 billion. Fast forward to Q2 of 2026, and that skyrocketed to $22.1 billion. A nearly 50% increase in a single year for a company of this sheer size is massive. Management notes this was largely driven by just an insatiable demand for their AI networking solutions and custom AI accelerators.
But look, top-line revenue is only half the story. We always have to check the gross margin. Gross margin is simply the meat left on the bone after paying for the factory, the silicon wafers, and the raw materials to actually make the product. Broadcom's gross margin expanded from 68% up to 69%. That means for every single dollar of revenue they bring in, they keep 69 cents before having to pay their office staff, their massive R&D teams, or their debt interest. Keeping 69 cents on the dollar, that is a highly profitable place to be.
Now here's what's really interesting, the difference between accounting profit and real cash. We say this all the time here at the EDGAR Brief. Profit can be an accounting fiction, but cash is reality. For the 6 months ended May 3, 2026, Broadcom reported an accounting net income of $16.6 billion. But their actual operating cash flow, the real hard cash generated by the everyday business, was $18.7 billion. Pumping out almost $19 billion in actual cash over just 6 months proves this business is an absolute cash cow.
And what exactly are they doing with all that cash? Well, they're piling it up. As of May 3, they are sitting on $19.6 billion in cash and cash equivalents. But wait, before we crown them the undisputed kings of capital, we have to look at the other side of the ledger. Contrast that beautiful $19.6 billion cash pile with the towering $64.9 billion debt load they are carrying. That's about $62.6 billion in long-term debt and over $2 billion in short-term debt due within a year. They took out a massive mortgage to acquire companies like VMware. So while they generate immense cash, a really significant chunk of that has to go towards servicing this mountain of debt.
Section 3. The Moat Check.
Why can't some scrappy startup just crush Broadcom tomorrow? Well, their moat is built on 3 really deep trenches. First, their immense scale and brand power. They spend billions on R&D that smaller players literally cannot afford. Second, a massive patent portfolio that legally blocks competitors from just copy-pasting their tech. But the deepest trench by far is their high switching costs. Think about it. If you are a massive global bank, Broadcom's hardware and VMware software are the foundational plumbing of your entire data center. It works, it's secure, it's heavily integrated. Your IT department would absolutely scream if you told them to rip out the foundational plumbing just to save a few bucks with an unproven competitor. The pain of switching is just way too high.
Which brings us to Section 4, reading between the lines. I found this quote buried in the risk factors and the management's discussion and analysis, and it is fascinating. They note that top customers are making greater demands on pricing, explicitly, quote, seeking to lease our custom AI accelerators, or requiring Broadcom to purchase and then lease to them full AI racks. They even mention alternative financing arrangements or novel or deferred payment models. Guys, this is a monumental shift. They are pivoting from just selling a product, like a simple vending machine transaction, to becoming a financial landlord, leasing out AI equipment over time. That completely changes the risk profile.
And right as they are making this super complex financial pivot to leasing, we find this fine print in an accompanying 8K. Chief Financial Officer Kirsten Spears is stepping down from her role on June 12, 2026. Sudden executive departures always warrant a closer look.
Let's look at the details of her exit package. The filing explicitly notes she is resigning without good reason, which is a legal term just meaning she wasn't forced out due to a breach of contract or a demotion. She'll transition to an independent consultant until March 2027. What's absolutely crucial here is that she retains her target stock vesting while consulting, but forfeits the above-target portion of her performance awards. This tells a silent story. It looks like an amicable, highly structured handover. But changing your CFO right when your biggest customers are demanding novel financing on multi-billion-dollar AI racks, that is definitely a management transition we need to keep a close eye on.
All right, Section 5, red flags and risks.
Okay, remember that crazy 42% number from the very beginning? That is a glaring red flag. If that single distributor coughs, Broadcom catches a severe cold. On top of that, they note that just 5 suppliers provide more than 75% of their manufacturing materials. That is an incredible bottleneck. Even scarier, they rely on single factories, like their Fort Collins, Colorado facility, as the absolute sole source for certain specific chips. One natural disaster could disrupt their global supply. And finally, there's that new credit risk. If they are leasing billions in AI hardware, they are now exposed to customer defaults. If a massive tech customer goes bankrupt, Broadcom doesn't get cash. They get stuck holding used servers.
And that leads us to Section 6, the bottom line.
So Broadcom is essentially a cash printing machine riding the crest of this huge AI wave. They are protected by incredible switching costs, but they are also heavily burdened by debt and shockingly concentrated in their supply chain and their customer base. For the next quarter's SEC filing, here are the 3 specific things you should track. 1. Is that 42% customer concentration dropping at all? 2. Are they using that $18.7 billion in operating cash to actually aggressively pay down that $65 billion debt pile? And 3. With a new CFO taking the reins, how is the balance sheet handling the credit risk of this new AI leasing pivot?
Which leaves us with this final massive question. Will Broadcom's pivot from simply selling chips to actually leasing massive AI hardware systems cement their dominance as the absolute landlord of the AI revolution? Or is it going to become a costly credit trap? That is your EDGAR brief on Broadcom. Remember, this was a translation of the filings, not a financial recommendation. Go read the original documents on sec.gov if anything here piqued your curiosity. Thanks for hanging out with us at the EDGAR brief, and we will see you in the next filing.